All right, let's just jump right in. Investing is easy, actually. I know, that sounds kind of crazy, right? Maybe a little too confident. But stick with me here, because by the end of this, you're going to see why it's true. And the secret? Well, it is not what you think.
You know how it is when you go to a casino? The house always wins. And let's be honest, investing can feel exactly like that. It feels like the whole game is rigged from the start, that these giant institutions like BlackRock have this massive edge. And you know what? They kind of do. But, and this is a big but, that doesn't mean you can't win.
So, okay, how do you find that winning strategy? Well, forget all those financial gurus you see online promising you'll get rich quick. The real secret, and this is going to sound weird, is learning from people who are just really, really bad at it. Seriously, it's a little backwards, I know, but if we can figure out exactly what not to do, we get a super clear roadmap for what we should be doing.
So, let's do it. Let's start right there, learning from the worst. We're going to create a profile of the classic bad investor. You know, the person who treats Wall Street like a Vegas casino and, well, usually walks away with nothing. Their mistakes? That's our curriculum.
Okay, take a look at these habits. What's kind of scary is how familiar some of this might feel. The bad investor. They're running on pure emotion, fear, greed. You see it in all the classic blunders, right? Dumping their life savings into one single super risky penny stock, or chasing after some tech stock that's already shot up 50%. They get this idea in their head that they've got some magic forecasting model that nobody else has. And when it all goes wrong, they double down, try to win it all back, which, yeah, pretty much always ends in disaster. It's not investing, it's just a gambling addiction with extra steps.
And all of this, really, it gets at a huge misunderstanding that trips up so many people. It's this idea of searching for the best investment versus finding an optimal one. They sound almost the same, but trust me, they are on totally different planets.
So let's break it down. The best investment? In hindsight, sure, it was Dogecoin, a crazy 35,000% return. I mean, wow. But catching that was like catching lightning in a bottle. It was pure dumb luck, a low probability bet you can't possibly repeat. Now, the optimal investment, that's different. That's something like a total market index fund. The returns are, way more boring, maybe 8 to 10% a year. But the strategy is all about high probability. It's repeatable. It's predictable. One is a lottery ticket. The other is an actual financial plan.
I mean, think about it. Hitting the best investment is literally like winning at roulette. Trying to find the next Dogecoin before it moons is the exact same thing as walking up to the table, slapping all your cash on one number, and watching the ball land right there. So, does that one big win make you a gambling genius?
No, of course not. The chance of a roulette ball landing on green is a measly 2.63%, so if you bet 10 grand and walk out with $350,000, you didn't outsmart the system. You just got insanely, ridiculously lucky against horrible odds. You wouldn't base your entire retirement on that strategy, would you? So why on earth would you do that with your investments?
Okay, so if we're not supposed to gamble, what are we supposed to do? Well, let's get to the solution. Let's talk about the guy who basically figured out how to take luck completely out of the picture.
This is John Bogle, the founder of Vanguard, and he is a total legend in finance. He's one of the few industry giants that pretty much everyone agrees was one of the good guys. His idea was so simple it was revolutionary. Stop trying to beat the market. Instead, he just created super low-cost funds that owned the market. And that one idea? It's estimated to have saved regular investors like you and me something like $1 trillion in fees. $1 trillion! That's money he could have put in his own pocket.
And this is his beautifully simple, just optimal solution.
The 3-fund portfolio. That's literally it. One fund to buy the whole U.S. stock market, one to buy the whole international stock market, and a bond fund just to smooth out the ride. The whole strategy isn't about picking winners. It's about owning everything.
But why? Why does this simple idea work so well? To get that, we need to talk about the most fundamental concept in all of finance, and that's the relationship between risk and return.
So first, let's get this one term straight: expected return. Now, this is not a guarantee. It's not a promise. If a stock has a 10% expected return, that doesn't mean you're going to get 10% this year. What it means is, okay, imagine you could run this investment in like 14,000 different parallel universes. The average return you'd get across all of those universes would be 10%. It's all about playing the long-term odds. So here's the deal.
some risks are worth taking because they give you a higher expected return. Think about it. Cash sitting in a bank account, it's safe, but its expected return is basically zero. Actually, it's less than zero once you factor in inflation. Bonds are a little riskier, so you get paid more for that risk, an expected return of around 4%. And then you've got stocks. They're the riskiest of the bunch, but that's why they also have the highest expected return, averaging around 10% over the long haul.
And that right there is why we invest in stocks. That's the whole game. Yeah, it goes up and down. It can be scary, but historically, it offers the absolute best trade-off between risk and reward. Taking on that calculated risk has just, mathematically, been the right move for anyone trying to build real, long-term wealth.
Okay, so owning the whole market is the way to go. But how in the world do you actually do that? I mean, you're not going to go out and buy thousands of individual stocks, right? Let's talk about the simple tool that makes this whole thing possible.
It's simple. You use something called a total market index fund. A perfect example is one called VTI. In one single click, you buy a little tiny piece of over 3,500 different US companies. Boom. You are instantly diversified across the entire American economy. Just like that. So what's actually happening when you buy in? Well, if you put, say, $10,000 into VTI, that money isn't just split evenly. It's market cap weighted. Fancy term, but all it means is the biggest companies get the biggest chunk of your money. So more than $700 goes to Nvidia, about $600 to Apple, and so on down the line. What's so cool about this is that your portfolio automatically stays up to date with whoever the biggest players in the market are, and you don't have to lift a finger.
And this brings us right back to the main point. It's so tempting to think, I can do better. I'll just pick a few hot tech stocks. And hey, maybe you get lucky for a year, maybe even two. But the goal here isn't to win for 1 year. It's to build wealth for decades. And the stats on this are just brutal. Trying to outsmart the entire market day after day for 40 years? It's a game you're almost guaranteed to lose.
So what is the goal? I absolutely love this line. You don't want to be the frantic day trader glued to the screen, stressed out of your mind. No. You want to be the person who makes the day traders mad, the person who quietly buys everything and then goes and lives their life while still coming out ahead.
So, that really just leaves one last question for you. What kind of investor are you going to be? Are you going to be the emotional gambler, chasing that one lucky lottery ticket? Or are you going to be the calm, cool, long-term owner, using a simple, optimal strategy that's actually designed to win? The choice really is all yours.